Welcome. Let's take a look now at a risk event for the week starting Monday, the 8th of January. And instead of an event to watch out for, I want to take a look at what's likely to happen for the US dollar. This week, we've seen recovery in the dollar, and that's really been the story going into the non-farm payroll data. Let's take a quick nod as to what happened with that data that we've seen out on this Friday. We were expecting 50,000 jobs to have been created in the US economy in the month of January. It actually came through at 49,000. But the really interesting stat was for the revision that we saw to the December month, where we got 140,000 job destructions. But in fact, that has turned all the way down to 227,000 jobs having been taken out of the US economy, according to the government data for December. The unemployment rate in this most recent look at what's been happening has fallen from 6.7 to 6.3%, and average hourly earnings came in at 0.2 month on month, 5.4% year on year. Well, now with a nod to what's happening on the economic data there, in the context of this recovery we've seen in the dollar, we're now over to New York, and Christopher Vecchio joining us now from New York, and his reaction, not just to this data particularly, but I think more so looking at this risk event taking us through into next week for the dollar. What are you witnessing in terms of this dollar recovery? How much further do you think it's got to go, Chris?
Hi, Jeremy, and thanks so much for having me here. The data this morning is very interesting because it was surprisingly on the nose. We were expecting 50K, we got 49K, but the dispersion of estimates coming into the print really was wide, from plus 400,000 jobs down to minus 250K. So this just speaks to how much noise there is right now in the US labor market data. We've seen really concerning initial jobless claims data, historically speaking, extremely high by any measure, still north of 700K. But I think the important news here, the context that this data now provides, is we have a US fiscal stimulus plan coming to pass. This morning, Kamala Harris, Vice President, cast that deciding tie-breaking vote to get through the budget blueprint for Biden's 1.9 fiscal stimulus plan. And in context of the fact that we saw fiscal stimulus and low interest rates, curated environment of low or negative US real yields for much of 2020, this could be the fuel that perhaps inspires the dollar to fall once more. Now, when I take a look at my charts here, I'm thinking about some of the recent price action in the dollar in context of this bullish falling wedge that we saw play out at the end of the year into the start of January. This is the dollar index here, Jeremy. And recently, this just past week, we cleared out that December 21st swing high. So I myself have been watching for further gains up closer to that 92.20 area, which had proven to be support through the latter half of 2020. Of course, the implications here are pretty important for the euro. The euro itself is 57.6% of the broader dollar index. We seem to be at a make or break point today, with the euro trying to claw back above that ascending trend line from the swing lows that we had in May and November 2020. But when I'm thinking about this data for the dollar the next week, there's a really important point that needs to be borne out here, which is one of the main movers for this market right now are the vaccination rates. In fact, there's a strong argument to be made that the reason why the British pound, for example, is faring so well versus the US dollar, despite the dollar's rebound, and another currency, the Canadian dollar, is doing so poorly in recent weeks, is in part because Canada is lagging while the UK is accelerating. In fact, if Canada were to continue at this current pace for vaccinations, it would take 9.5 years for the country to reach that 70% threshold for herd immunity. Meanwhile, the UK taking these what seem to be a little bit more extreme, more adventurous steps towards vaccinating the population, the data has borne it out. There's still highly efficacious rates for the AstraZeneca vaccine, even if the second inoculation comes more than 3 weeks after the initial dose. So the British pound, to me, in an environment where the US dollar perhaps begins to fall back, it's best positioned to take advantage, as it has been the strongest currency in a difficult environment thus far.
What is it, do you think? You're talking there about some of the factors that could well see the dollar high. How much higher have we got to go? You talk there about levels to watch on the dollar basket, but when you're looking at some of the other currencies such as the euro, you're right, the Eurozone has its problems in terms of the vaccine rollout, but the euro has been very much a stronger currency than the dollar. How long do you think it is before we see a turn back to character, if you like, and we see a weaker dollar and that euro rising again?
I think that's close by. Now that we have some movement on this US fiscal stimulus impulse, it's not going to be a tailored down package. It's not going to be whittled away. We're going to see the full $1.9 trillion come down the pipeline. No $600 billion, no disappointment. And so this impulse of the negative real yields can come back and haunt the dollar fairly quickly here. The euro, though, it's really interesting because a few weeks ago, back at the end of December, I was talking to some people in the IG US trading desk here, and I was talking about the ECB's year-end target for the euro, which this year is 118. Historically speaking, the ECB has only cared about euro strength whenever the euro is more than 5% above its year-end target. So if you put a 5% premium on 118, that gives you an exchange rate in the mid 123s. Now, where did we top out earlier at the start of this year? Right there, right above 123. And so in the last week, we've had two particular developments. One, the ECB has come out and announced that they want to do an exchange rate study. They want to understand why, despite the fact that the euro area has a lower rate of inflation, lower growth rates than the US, that the euro is stronger than the dollar. And secondly, they've come out and said that markets are underpricing the chances of another rate cut. If these aren't explicit efforts to talk down the euro, I really don't know what would be in this era of central bank jawboning. So there is really this tug and pull right now. If the ECB is not going to be successful in getting a weaker euro, it's going to be because of the predominant stronger market impulse that's driven by the dollar. And I do think now that we have this fiscal stimulus here, we see higher yields, higher stock markets, but a weaker US dollar. That's an inflation trade. That's a risk on trade. And the dollar, as the world's reserve currency, as a safe haven, stands to be on the losing end, just like, say, the Japanese yen or the Swiss franc.
Yeah, Chris, it's a pleasure. Thanks indeed for joining us, breaking it down into some easily understandable points to watch out for as we continue to watch the movement of the dollar into the new week. That's Chris Vecchio from Daily FX in New York. For more videos from us here at IGTV, join us on Twitter at IGTV and subscribe to our YouTube channel.